would say that I think for most of my career is a pretty standard of like follow the normal investment advice, invest in your 401k, max that out, get your tax savings, kind of like long-term mutual funds, don't try to beat the market. So I really bought into the big public equity markets is really hard to beat. And I think there's a lot of evidence and that was the way to go. Just long-term mutual fund investing, just continual save. But once my income got to a place where I was able to like have additional capital outside of that, I started thinking about diversification outside of the stock market. Been through multiple recessions. Some of the first money I ever invested was in 2008, and just saw that get cut in half. So understanding what that feels like, but also getting to rebound from that. And now, obviously, stocks are worth way more. So, kind of riding through the last 15, to 20 years has been great, but there's some volatility there. So, finding other areas like real estate or finding these other kind of investment classes that could provide some correlated investment return to the stock market. So having a little piece in every pie seemed to be interesting to me. So kind of got introduced to Funder and kind of the SMB Twitter space just by chance, and started listening to the podcast, and kind of like I got really involved in being interested in this area. So he up into writing my first check for main shares, I think was first having enough capital that it wasn't like my money or something into one deal, because obviously I just talked about how diversification is important, something that is an important factor in kind of the investment landscape. I started learning about the multiples at which small businesses trade, and then really starting to understand like, oh, this is like, think about real estate cap rates, or essentially like the inverse of the multiple business multiples, and then also understanding like, oh, in public markets we have PE ratios, we have like, there is this thing of essentially price to earnings, what things cost versus how much they're making. Okay, so you have this idea public markets are in the teens and 20s and 30s, and growth stocks are high and all this stuff, and I could understand that. But then when I started really thinking about small business being 3 to 5 times EBITDA, a lot of opportunity here to make money. Obviously, as higher risk because they're small companies, there was actually something that you could do more due diligence on specific things and actually impact. So in the big public markets, I firmly believe it's really hard to know long term your company's going to outperform. But in the small companies, it seems like actually it matters a lot which company you pick. So the risk profile can go up, but your returns could also go up. And if you a lot of good due diligence and you spread out maybe over a number of deals, you can actually have pretty strong returns. Don't really have anything to do with the public stock market, deal with the local market that you picked and the operator, the deal terms and the things that you got in, and all of those do matter. And so doing your research there